Awesome, awesome, awesome. Okay, well, gentlemen, thanks so much for joining me again tonight. I know for a few of you, it's the third week in a row that you're tuning in here at 7 o'clock. So especially appreciate those guys. But whether it's your second time or first time, thanks for joining on. So today we're going to focus on the third topic of our investment series, which is investing money. So in week one, we hit on some of the key concepts from taxes to debt to credit scores. Last week, we focused really on budgeting. And when you're managing a budget well, obviously part of that involved what we were calling the 20% last week, saving our money for ourselves down the road. And I have to say, a lot of people struggle with kind of doing any savings at all. But those who are able to, get themselves to do it, they should really be taking it one step further, which is investing the money. Make the money work for you, so that down the road, when you need this for retirement or whatever it is that you need it for down the road, this has grown exponentially beyond what you have put into it. But there are some pretty important rules to navigating investing. So I want to kind of give you guys a foundation of those important things today. So what we're going to talk about are the benefits of compounding growth. We're going to talk about common investment vehicles. So basically this means like what's a stock, what's a bond, what's a mutual fund, probably all things that you've heard of before, but I want to make sure that we have a pretty good grasp of what they mean. Where we save and invest in money, we're going to be talking about retirement accounts. You've probably heard of 401ks. You may have heard of Roth IRAs. I want to make sure that we talk about what those mean. And finally, we'll talk about the relationship between risk and return with investments. So basically risk and the growth potential, because there's always a trade-off between those two things with investing. There's really no free lunches. Usually something that has a lot of growth potential also carries a fair amount of risk and vice versa. So first, I want to talk about this concept of compound growth. And to frame it, I want to ask you guys a random question. So just like Joe was kind of talking about gift cards, let's say that I was going to make an offer to you guys, and you guys can only pick one of the two. Offer one, I'll pay you 1 cent today, but I promise that it would double in value every day for 30 days. Offer two, I'll pay you $1 million today, and if you want to, you can invest it. Which one of these two scenarios is going to be worth more money at the end of 30 days?
One.
One?
Yeah.
Does everyone agree one? Anybody think two? I mean, I have to say, offhand, you'd think that two is a no-brainer, and for a lot of people, when I do bring this up, you might say one just because it sounds like such a trick question that two seems too obvious. But answer one, or scenario one, would actually produce $5.3 million at the end of 30 days. And that is because of a concept of compounding growth where, it's doubling in value every day, and that's building on top of each other. And so this is a quote from Albert Einstein, and he said that compounding interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And I love this quote because it speaks to some of the things that we've talked about as a group over the last 3 weeks. He's being kind of harsh in how he's phrasing it, but he's basically saying people who understand how interest builds and accumulates over time, they invest their money and they earn that growth. People who don't, they're the ones that are in debt, they're borrowing money. And like we talked about in our first week of presentations, when we're borrowing money, we're paying somebody else interest. So Einstein said, compounding interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Now, outside of, in the investment world, compounding growth is kind of a very financial sounding jargon term. Beyond investing, we kind of call this concept a snowball effect, something that picks up steam as time goes on or as things roll on. So let me kind of show this to you in a different way that's not quite as dramatic. In my example about the penny turning into 5.3 million, doubling every day is the same as a 100% return every single day for 30 days. In the real world, there's no investment like that, but that does, I think it kind of exaggerates the point really nicely. Here's a little bit more of a realistic scenario. Let's pretend that you were guaranteed to earn 10% interest every single year, and you started with $10,000. So 10% on $10,000 is $1,000. At the beginning of year 2, you would therefore have $11,000. That next year, you still earn 10%, the exact same percentage, but now you have more dollars, so 10% of 11 grand is $1,100, building our account balance up to 12,100. We still earn the same percentage of 10%, but 10% of $12,100 is $1,210. So now our balance builds to 13,310. Same percentage, but we have more money, and so 10% is worth more money. And now the account value has built to 14,641. So you can see here, in this scenario, there's no additional money being contributed. The exact same percentage is being earned year in, year out, but this is that snowball effect, or in investment terms, compounding growth, where as money builds, the speed at which it grows increases and increases more rapidly because of compounding growth. As we accumulate more dollars, any given percent return or interest is going to also equate to more dollars and therefore help our balances build significantly over time. So here we see, and I will say, I'll touch on this later in the presentation, the stock market has averaged somewhere around 9 or 10% per year over the past several decades. So while 10% is kind of on the high end of a normal assumption, it is in the realm of possibility. So imagine if this concept we stretched out for the 30-year or 40-year time horizon that you guys might have to accumulate money for retirement, and you couple with that with the fact that you might be adding to this balance instead of just letting it grow. I mean, imagine what that chart would look like. So this compounding growth is really going to help you, and that's the reason why investing is so important. Let's look at this in a different way. So let's pretend that we really took to heart what we were talking about last week, and both Joe and I were like, all right, we're pumped up. We're both going to make sure that we carve out a piece of our income, and we're going to make sure that we save that to take care of our future selves. We're going to save that for retirement. And so we both decided to invest $5,000 per year. I decided to save that into a bank account. Joe decided to invest that money. So I take my $5,000 every year, and I talk to my bank, and they say, we have a great bank account for you. It's going to pay 0.5% interest every year. So I put my money there, and for 30 years, I save my $5,000 every year. I earn my 0.5%, and I end up with an account balance at the end of 30 years of 162 grand. So I invested 150,000, and because of the growth over that time, it grew to 162,000. Now Joe decides to save the exact same amount of money for the exact same amount of time, but he puts his money into an account that has some stocks and some bonds. It's invested. So he averages a 6% growth rate per year. He would have saved the exact same amount of money for the exact same span of time, which means he still put in $150,000 just like I did. But look at what his balance would have grown to. It would have grown to 420 grand essentially. I mean, this is almost shocking when you look at it. Two scenarios, same amount of money saved, not a crazy difference in the percentage growth, right? 0.5% versus 6%. I mean, this isn't 50% versus 1%. And look at what the dollars end up being. So you can imagine, I mean, for those of you, it's so important that we save our money, but look at the difference, especially when we're trying to accumulate money for retirement, where we're going to need to replace our income for a number of years. Look at what a difference investing can make. And I go back to what I just said a slide ago, where the long-term average of the stock market is 9 or 10%. So a 6% growth rate is a pretty modest and normal assumption. One other lesson really understanding compounding growth is starting early. This is something that I think you guys as a group are in a great position to take to heart, because you are about to start in on your careers as opposed to kind of later in the game. I would say that 9 out of 10 people that I talk to, at least it feels this way, say to me the same exact thing. They say, I wish I had done this earlier. I think Joe's even said this, at the beginning of this call. Most people I come across say the same thing. I wish someone forced me to do this earlier. I wish I had forced myself to do this earlier. And here's why in a quantitative example. So I know there's lots of numbers and bubbles and words. Let me just explain this scenario to you simply. We have two people. We have Susan and Larry. Both of them are going to retire at 65 years old. Susan starts saving though when she's 25 years old. So she ends up saving for 40 years until she's 65. Larry, and she saves $100 a month. Larry starts a little bit later. He starts saving at 45, so he only saves for 20 years, but he saves 3 times as much as Susan every month. So he saves $300 a month for 20 years, whereas Susan saves $100 a month for 40 years, but they both retire at the same age of 65. Susan, saving $100 a month for 40 years, would have put away $48,000 of her own money over that time, whereas Larry would have put away $72,300 a month for 20 years. But when they're 65, look at the difference in their account balances. Susan would have accumulated $191,000 plus when she was 65 years old. He would have only accumulated $136,000. And by the way, they're earning the same growth rate of 6% in this example. So Larry had put away out of his own pocket significantly more money than Susan had, $72,000 versus $48,000, but she accumulates more money because by starting earlier, she got compounding growth to work for her. And that scenario we looked at with the $10,000 building and building and building, that's what allowed her to accumulate so much more money by the time she was 65. So what this means for you guys is when you start off in your careers or just to a place where you're able to set aside some additional money, it is so much better that you guys start earlier and do something small versus wait longer until you feel like you could do something more significant. So, sometimes I come across people, I help people with their retirement plans at Upstate Hospital, for example, and they say, oh, I feel like I can only save $25 per pay. What's that really going to do? You'd be shocked at what that does after, 5 years even, but certainly 10 years and 30 years. So start earlier, even if it's a small dollar amount. All right. So hopefully I kind of sold you on the benefits of investing because of this concept of compounding growth. But now that we're raring to grow, I got to give you guys a little bit of guidance of, how do we go about doing this? How do we go about earning, 6% growth to 10% growth, something like that? So I want to kind of talk to you about some of the common investment vehicles, but let me pause for a second. Any questions on some of those examples that I talked about with compounding growth? No, doing okay with that? All right. So let's define some of these things that we've probably heard about before, but maybe we don't have a real solid grasp as to exactly what they mean. Stocks. What is a stock? A stock is when you own a partial ownership of a company. So a lot of times people, I get the impression, feel that investing in the stock market is like gambling. It's basically a game to try to earn money. And it's not. The important distinction is that when you own stocks, you own shares, and you are a partial owner in that company. You literally you will get things in the mail where you're entitled to vote on the business affairs of the company. And so this means as an investor that you're participating in the growth and the losses of a company. So if you bought shares and partial ownership in Apple way back in the early days, you would have participated in a lot of the growth of that company. If you bought shares of Kodak, when they were still stuck on physical film and they weren't kind of getting on the bandwagon of digital cameras and things like that, you would have participated in the losses of that company. There's no performance guarantees with stocks. So this can work out really, really well for a stock investor. It can work out really, really poorly. And so that's something that you need to be conscientious of heading into investing in them. So the advantages is there's really strong growth potential. As I said, over the last several decades, the average for this U.S. stock market is about 9 or 10% per year. However, the disadvantage is that these can fluctuate wildly. So to actually experience this growth rate of 9 or 10% per year, unfortunately, it's not the sort of thing where you earn 9%, 9%, 9%, 9%, like my example a few slides ago, or 10%. Unfortunately, this is something where you might earn 25% one year, you lose 10% the next year. So you got to be ready to ride the roller coaster if you actually want to end up, experiencing the long run benefits of investing in the stock market. So a lot of growth potential, but it can fluctuate pretty significantly. What's a bond? A bond is a more conservative investment vehicle. And so what this is basically you giving a loan to a company or a government, and in exchange, they're going to give you a bond, which is a contractual obligation that says we'll pay you back the amount of money you just gave us in X amount of years. And along the way, we'll pay you interest every year. So for example, a 20-year US government bond. This is a really common type of bond. They're sometimes called treasury bonds or treasuries. In this scenario, an investor might give the US government $10,000, and the government says, we'll pay you back in year 2040 this $10,000. And every year going forward, we'll pay you 1.5% interest. So between 2020 and 2040, you get $150 every year. And then in 2040, you get your 10 grand back. The reason why this 1.5% is kind of a modest interest rate is because the government is a pretty safe entity to loan money to. And so therefore, they don't need to compensate investors with a high interest rate because they're pretty safe. If instead you're buying a bond of a pretty small or higher risk company, you're going to expect a much higher interest rate and higher interest payments over the years because you don't necessarily know with the same degree of certainty that they're going to be able to pay you back at the end of 20 years. And so the interest that you get on a bond is commonly tied to how safe of a company or government you're buying a bond from. So because these are contractual obligations, bonds are much safer historically than stocks are. So they're much lower risk. And they do tend to historically offer better growth rates than a bank account. So they can vary very widely, but I would say an average growth rate for bonds might be 3 or 4% per year, much better than the 0 to 0.5% people are getting in their bank accounts. But still, that pales in comparison to the 9 or 10% we talked about the stock market averaging. Now, if you're getting close to retirement and you can't go through the ups and downs and risk having a recession roll around and wipe out half of your stock portfolio right before you retire, you might rely more heavily on bonds. If you're a young person and you want to see this account grow nicely over time, bonds might feel a little too conservative to be heavily invested in. You might focus more on stocks. Mutual funds. So a mutual fund, in my opinion, is probably the way that most people should be investing their money. What a mutual fund is it's a single investment vehicle under the hood of which there are tens or hundreds of individual stocks or bonds. And each mutual fund kind of has a specific focus. So you might have a US large company stock fund. There might be an international stock fund. But inside of each one, there's hundreds of individual securities. So what a mutual fund does is it reduces company-specific risk. So some of you guys might remember, in 2018, maybe 2019, there were a couple of different plane crashes involving Boeing 737 planes where there were a lot of fatalities, and they realized, oh, it's all the same model of Boeing planes. Now, if you were a stock investor because you decided, oh, I'd rather earn 9 or 10% than 3 or 4%, and you decided to go out there and buy Boeing, if that was all you held in your investment portfolio, you would have lost a significant amount of money over the past couple of years. However, if Boeing was one of 100 companies inside of your mutual fund, then you have 99 other companies that were really not affected by this Boeing specific issue, and therefore it would not have hit your portfolio quite the same way. So a mutual fund gives somebody the ability to diversify within one single investment vehicle. It also allows you to diversify with a relatively low dollar amount. So you could buy a mutual fund oftentimes for $100, or some of them have minimum investments that are $1,000 or $2,500. But again, you make that investment into a mutual fund, and you have hundreds of individual stocks. Amazon stock alone costs about $3,200 for one share of it. Google costs $1,700 for one share of it. So you need a fair amount of money just to buy two companies. So mutual funds gives us a way where for $100 or something like that, we can have a portfolio that's diversified across hundreds of different stocks, for example. And a fund tends to focus on specific categories or sectors. So, sometimes it's even more granular than what I mentioned. Sometimes there's, not just tech focused funds. They might be focused specifically on robotics or specifically on cybersecurity. So it can get pretty specialized. And that's why even though one mutual fund might be very diversified in itself, a lot of times it's prudent to own multiple mutual funds because they're each focusing on different areas. So you can see the different logos of the various companies. Imagine this brown box as if it's a mutual fund. All of them are being held in the one fund. So you owning this one mutual fund, your money's pooled together with a bunch of other people, and that's how they're able to buy all these securities at once. So the advantages is the diversification. You're still invested, in the example of a stock fund, in a vehicle that could average 9 or 10% per year, and so you have good growth potential. But because the investment companies need to manage these funds, buy and sell these various stocks, they need to do tax reporting and things like that. They do charge management fees, which you don't have when you buy an individual stock. So there's some expenses involved. And sometimes diversification can dilute our growth potential. So like I used the Boeing example where it was nice that we had 99 other companies so that, a plummeting Boeing didn't result in a plummeting portfolio. However, let's say that Amazon grew by 500% over the last 10 years. If everything else was growing at 10%, it might be holding you back a little bit. Now, that being said, I go back to, what I mentioned earlier. I still feel like because this offers diversification, this is probably the right way for 90% of people to be investing. It's not quite as fun and as sexy as when you're picking an individual stock that might hit it big, but you're not going to, hopefully lose your shirt quite the same way either. So I think that this is definitely something to pay attention to once you're able to do some investing.
Rory's got a question.
Oh yeah, go ahead.
I got two questions. So can you have, when you do like the mutual fund, can you have any type of category of stocks or whatever? Can you have like Nike and then with like all this whatever?
Yeah, so you can't. I should have mentioned this as a disadvantage. It's a great point. You don't have control over what's in the mutual fund, but you can pick mutual funds that are very, very customized. So, like if a very common type of one is one that focuses on U.S. large company stocks, that would have Nike in it. It would also have Google and so on. If you didn't just want large companies, you wanted specifically like apparel companies, there are some funds that are that specialized. I was just talking to a client today who was really interested in artificial intelligence, in robotics and cybersecurity. So we were picking out funds that specialized in those areas precisely. So they might have 80 different stocks all geared towards cybersecurity. I have some other clients who are very socially conscious. They don't like to get involved in oil companies and things like that. They want renewable energy. There's funds that focus only on the stocks of renewable energy sources. So you can get pretty specialized, but you personally can't dictate what the fund holds.
And so when you buy the mutual fund, is it a certain amount that you have to have in there, or like you can make up your own amount?
Yeah, so a lot of mutual funds, they'll have minimum investment levels, and it can range. Some mutual funds, sure, I see minimum investment levels of $2,000 or $3,000, which pales in comparison as to how much it would cost to actually, buy a portfolio of 100 or 200 stocks that they hold. But still, that's kind of on the high end. Many mutual funds have minimum investment levels of $100, $250. A lot of fund companies will say, if you set up a monthly automatic contribution, we'll let you invest in our funds for as little as $25 a month because we know you're going to be adding it over time. So they do have different minimum levels, but they are fairly modest.
Makatube.
Okay, so when you're like investing into the mutual fund, is it like the money that you invested? Is there like a little bit of the money goes in each of the stocks, or is it like you put in a certain amount yourself?
Yeah, great question. So that's kind of the nice thing about these is for a lot of people, picking stocks and the nitty gritty of the investments, it's just not really their forte, So these funds are all managed by a professional team of investors whose sole job is to sit in front of their computer and research all this stuff. A lot of them have Ivy League degrees and things like that. This is their whole job. And so they are the ones that are kind of picking which stocks to include. Sometimes even once you buy a stock for your fund, you got to get rid of it because either there's better companies out there or the stock that you thought was going to do really well, their prospects changed. So they'll get rid of it. So it's not on you as the investor to make those decisions. The fund company will do it for you.
Okay.
And that's part of the reason why, when you look at the fund environment, there are, especially when you're looking at a category like US large company stocks, there's hundreds, maybe even thousands of funds that focus on the same thing. And so, one of the roles that I play for my clients as a financial advisor is helping them navigate this a little bit, say, we want this fund as opposed to some of the other ones because the fees are lower or, their performance as a management team has been much better.
Any other questions before we keep moving? I love the questions, guys. I love that you're thinking about this. I wish I had this presented to me at your age. I really do.
All right, guys, I'll keep rolling just so we can kind of cover it all. But let me take a step back and just say, what is the stock market? We talk about stocks and bonds and mutual funds. What's the stock market? We probably hear this all the time. The stock market's up today. Market fell 300 points. What does that really mean? When people use this term, the stock market or the market, they're referring to the performance of an index. And what an index is just a basket of individual stocks, kind of like the fund concept we were just talking about. But there are some prominent indexes out there used to measure what the general stock market is doing and the health of the US economy. So two popular ones, when people are talking about what the market's doing, they're probably talking about one of these two things. So one is the S&P 500, which is basically 500 of the largest US companies inside of one index. And so this would be like Apple, Microsoft, Amazon, Facebook, etc. The other market index that's very common, so when people are talking about the market went up 300 points today or was down 500 points today, they're talking about the Dow. The Dow is smaller. It's just 30 companies. And it's kind of what the purpose is to give a broad reflection of the US economy. So rather than being based on just the largest companies, the 30 companies they're choosing for the Dow they want them kind of across industries. So you might have Apple, a tech company, Disney, Walmart, Johnson & Johnson, a healthcare company, Verizon, Visa, all of those to give a nice reflection of across various sectors what the economy looks like. So these indices are what people are talking about when they're referring to what's the stock market doing. There are funds that you can invest in that mirror exactly the performance of these indices, and that's what you might at some point hear the term index fund. That's what it is. It's an investable fund that will mirror the performance of what these things are doing. All right, so let's chat a little bit about where do we save and where do we invest. So first off, I'm obviously a huge fan of investing money. I've probably already pointed out very clearly the benefits of that. However, we don't want to be investing every single dime that we have to our name because they can fluctuate quite a bit. I would say anybody that who's 30 years old or older probably remembers the financial crisis of 2008, 2009. In 1 year's time, the stock market lost about 50% of its value. So people who had saved up $1 million for retirement, in 1 year saw those savings dwindle to 500,000. Even this year, in March and April, from March to April, when COVID became such a scary concern for investors, the market fell by 30% in a single month's time. So someone with 100 grand saw that those savings fall to $70,000 in a single month. So for needs that might arise, you always want to invest your money and save your money into places where that are based on when you might need the money or how much accessibility you need to it. So if you think that you might need your money for some purpose in the next 0 to 5 years, then you want to keep it very short term. Keep it in those emergency funds we talked about, like a bank account, where it's not going to grow much, but it's also not going to lose, and it's going to be really easily accessible. If you have a window like 5 years or more, and certainly for retirement, we want to be investing the money either into a non-retirement account or a retirement account. But anything that's short term, that we might need in the very near future, we want to just keep in a bank account. So retirement account versus non-retirement account. Both of these are pretty broad terms. There's lots of different kind of sub-accounts that fall under these categories, but broadly, all retirement accounts have tax benefits to them. Non-retirement accounts, they don't have any tax benefits, but they are very accessible. And so with a retirement account, while they have tax benefits, you can't just dip into them at any age you want to without penalty. Non-retirement accounts, you can dip into them at any age, but you don't have any tax benefits. And tax benefits is a big deal. So if you're saving for a long-term goal like retirement, you really want to think carefully about saving into retirement accounts and getting these tax benefits. You'll remember, for those guys that were on the first call, that we have a progressive tax system in the US, meaning that somebody who makes 100 grand, the first 9,000 is charged 10%, the next chunk 15. So average together, the effective tax rate would be somewhere around 21%. So if someone has a salary of $100,000, they're paying away 21 grand in taxes. So trying to mitigate this, if we can, is a big deal, and that's why retirement accounts are so beneficial, because we're serving two purposes. We're saving money for our future selves and our retirement, but we're also minimizing the taxes that we're paying away. So with retirement accounts, the magic age tends to be, and these are kind of general rules of thumb. There are a bunch of exceptions, but I just want to keep it simple by giving you the general rules of thumb. The magic age for retirement accounts tends to be 59.5, meaning that if you try to draw from a retirement account prior to 59.5, not only are you going to get hit with taxes, but you'll also typically get hit with a 10% early withdrawal tax penalty. So let's say that you took my advice to heart and you were like, I'm going to save 20% of my income towards retirement, and you decided to put it all into your IRA. And so you put in 10 grand into your IRA, then you got a job and you're going to move across country. So you need to pull out some money. You need to liquidate $10,000. Well, if you did this at age 35, you're going to pay about 20% taxes on it. And then the additional 10% penalty is $1,000. So you end up with just 7 grand in your pocket. $3,000 went away to taxes and penalties. So retirement accounts are great, but you need to know that this is something that the dollars that you're setting into them are for the long term. You don't want to set any money into them that you think you might lose prior to that point. So for any savings and investing that you're not ready to commit to that time frame for, that's where you want to utilize non-retirement accounts. I hope I didn't scare you too much with that, because I'm a huge advocate of these retirement accounts, and it's so important because to replace our incomes once we stop working one day, it takes a lot of time and it takes a lot of savings. And so if we can save a lot of taxes along the way, it's important. But we do have to realize that we can't touch these without penalty for a certain period of time. Let's focus specifically on retirement plans and kind of explain some of the types of plans that you have probably already heard a little the term, but certainly will as you start off on your career. So within the concept of retirement plans, remember, all retirement plans have some kind of tax benefit to them, to incentivize us to save into them. But within retirement plans, there are employer affiliated retirement plans that we have connected to our jobs and offered by our employers. And we have individual retirement plans. which are called IRAs, individual retirement accounts. These are not connected to any employers, even though they have tax benefits. We fund them from our bank accounts. Employer plans like 401ks and 403bs, we save through our payroll deductions from getting paid from our employer. So when you hear the term 401k or 403b, those are things offered by your employer. When you hear IRA or Roth IRA, that's something that people are doing on the side. All of these have tax benefits, but we have employer plans and individual plans. Lots of differences between the two. Employer plans have much higher contribution limits. So you can put in, $19,000 to $26,000 into those, whereas you can only put in $6,000 to $7,000 into IRAs. So there's some differences between these things, but they all have tax benefits. Everything that I have highlighted in green is commonly a pre-tax type of plan. And what pre-tax means is that when you contribute to it, you don't pay any taxes on the money that you contribute. And so that gives you a tax break today. The money then grows inside of the account without being taxed. But when you withdraw from it down the road, you pay taxes then. A Roth, and I will say on this slide, I only have Roth IRAs. You're just starting to see more and more companies offer Roth 401ks and 403bs. So the term Roth in general basically means the opposite tax structure. When you contribute, it's an after-tax contribution. You get no tax benefit today. It grows without being taxed, and when you withdraw from a Roth IRA, it's completely tax-free. This is one of these things, this little note here, that if you remember just a couple things from the presentation, I would say, one, start early, even if it's a small dollar amount, because compounding growth is going to be your friend. And two, if you start at an employer that offers you a retirement plan and they offer matching, you always want to contribute enough to get the maximum match. What that means is that employers oftentimes, if they offer a retirement plan, will offer you a deal that says, hey, if you put in money, employee, we'll also put in some money to match that. So if you put in $2,500 a year, we'll also put in $2,500 a year. That is free money. You just need to set aside enough money for yourself in order to get it from them. And so you always want to make sure that you're contributing as much yourself that you need to get the maximum amount from them. A lot of times they're going to cap their commitment. So they might say, a common one is like they might match up to 3%. So that means that if you put in 3%, they'll put in 3%. If you put in 5%, they're still only going to put in 3%. But if you were to only put in 1%, they're only going to put in 1%. So that's where I'm saying in a deal like that, you want to make sure you're doing at least 3% to make sure you're getting the most from them. So if you started a job, it's a good question to ask. Do you offer a retirement plan? And if they say yes, do you offer matching, and what is it? Because you want to make sure you're taking advantage of that. All right, let me show you an example of saving pre-tax. So say someone earns $2,000 every paycheck. If they don't save any money before taxes, that's all going to get taxed in their paycheck, and hitting their bank account is going to be $1,600. Now say this person is saving $200 before taxes into their 401k account at work. So first the $200 goes into the 401k account and gets invested, and then only $1,800 gets hit with taxes, meaning that $1,400 hits their bank account. But keep in mind, you still have the $200 in your 401k account. So from this $2,000 paycheck, you've actually held on to $1,640 versus $1,600. The reason for the difference is because this $200 that you contributed did not get hit with taxes. You hung on to that, and that extra $40, not only did you hang on to, but it's going to be accumulating interest for decades and compounding growth. So this is one of the huge benefits of taking advantage of the tax provisions of retirement accounts. Big fan of Roth IRAs for young people. So remember, this is the opposite tax benefit. You get no tax benefit when you contribute. So basically you're paying taxes on the money today, but it grows without being taxed, and you pay no taxes when you withdraw from it. And the reason why I love it for young people is because when you first start your career, you're probably at the lowest income level and therefore tax bracket that you're going to be at over time. So to pay the taxes today at maybe a 16% tax bracket, and when you're pulling money out down the road, not owing taxes when you're at a much higher tax bracket can be pretty savvy. That's one reason. The other reason is that younger people, you have decades for this money to grow. And as we saw from our first few slides, you give compounding growth enough time and you're going to see a lot of growth over those years. So if all of that growth is not taxed at the end of the day in a Roth IRA versus taxable in a pre-tax account, I think that kind of tilts the scales a little bit for a young person. So, when you guys get to the point where you have a little bit of extra money to save, I'd be a huge advocate for a Roth IRA. All right, getting to kind of the last concept here, risk versus return. Guys, always remember that there's no free lunches with this stuff, probably with few things in life, but certainly with investing is no exception. You don't want to get too greedy with this stuff and try to target something that's been, earning 15% per year, thinking that it's going to do that every year, because there's always, the more growth potential an investment has, the more risk that it has. And what risk means is just the possibility that it could go down and how much it could go down. So this little chart just kind of shows that stability of principal view is something like bank account. It's pretty low risk, but you also can't expect a very high growth rate. When you get into international stocks or small company stocks, a lot of risk, but hopefully you'll be rewarded with that with higher growth rates. So yes, better growth is better than little growth when we're investing, but you also need to be respectful of the amount of risk that you're taking. And that's why diversifying is so important. So let's look at a quantitative example here. If I could predict the future and I were to tell you that tomorrow your investment account's going to lose 50%, but the next day it will earn 50% again. Immediately thinking about that, you'd be like, oh, okay, I'm fine then. If I have 100 grand a couple days later and I'll be right back to my 100 grand. That's not the way that investments and growth works. If you lost 50%, your 100,000 would fall to 50 grand. So the next day, if you earned 50% back, 50% of 50,000 is only 25,000. So a 50% gain would only take you to 75,000. You still would be far off from your starting value. So it takes an 100% gain to make up for what was originally a 50% loss. And this is why we need to be so respectful of the risk we're taking when we invest. And even though this is a dramatic example, it is not out of the realm of possibility. Investors have seen this in recent memory. We saw this in 2008 to 2009 during that financial crisis. The market fell about 50% from its high point to its low point. We saw this when the tech bubble busted in the early 2000s around 9/11. Market fell by about 50%. Happened in the 70s, happened in the Great Depression. So, history says that this we'll probably see a market environment where that happens, once or twice in your lifetimes. So imagine that somebody, had a little bit of conservative exposure and they minimized that loss in 2008 or 2009 so that they only lost 30%. During that time period. Then it would only require a 43% gain to get back to where they were. And this is why, especially when you're saving for retirement, you want to be a little more conservative as you get closer to needing the money. Because, if you need to make up an 100% gain for this loss, it might take you 5 years, like it took people in 2008. The market didn't get back to its original level until 2012. If you only need to make up 43%, you'll get back to where you were much sooner. So to finish up, the other thing that I think is so important, I don't really have time to drive this point home too much, but so you'll just have to take my word for it. When you look at a chart like this, but by the way, this is the Great Depression in 1929, and this is the U.S. stock market measured by that S&P 500 index I talked about with 500 largest U.S. companies. It looks like this investing in the stock market is a can't lose strategy, right? $100 invested right here would have grown to 420,000 right here. So if you stay along for the ride, investing in stocks can be quite fruitful. However, it's not always a smooth ride. All these little blips were quite dramatic declines. I mean, we're talking about world wars that caused huge declines in the market. You're talking about the tech bubble busting, the 2008, 2009 financial crisis. Lots of events will always be going on where the stock market's going up and down. It feels like a really uncomfortable time to invest, including COVID. A lot of people were like, we've never seen this before. I'm going to get out of the stock market. The market is really resilient when you give it enough time, but you do need to give it enough time. One of my greatest mistakes as an investor, when I was in college, I had a little extra money through working, and I invested in Netflix. And Netflix was about $20 a share at the time. And I didn't have a ton of money. So like we were talking about with mutual funds and with stocks, like I pretty much invested in one stock at a time. So Netflix started to go down and I got bored with it. And I said, oh, I'm gonna jump into something else instead. So I sold Netflix when it was like 24 bucks. You know, how stupid was that? If I had just hung on to it, you know, let me see what Netflix is at today. It's $524 today. Imagine if I had just hung on to it from when it was 24 bucks. You know, and so oftentimes getting out of your investments early is much more costly than sitting in the investment as you watch it go down, which is stomach churning. But, you know, you got to give them time to rebound. That doesn't mean never sell your investments. If you were invested in Blockbuster and not Netflix, it probably would have been wise to cut your, you know, to get out early. But by and large, you really want, I'm a big believer in the buy and hold strategy where you pick good investments and you give them enough time to do their thing. All right, guys, I know that was, you know, running through a lot of big points quickly. I wanted to make sure we at least scratch the surface of, you know, some of the things that I think are so important. I want to leave the rest of the time here for questions though. So what do you got for me?
So Salimo says, what is the worst case scenario for someone my age, I think like 17, 18, senior in high school, to